Hello guys, this is Investing for Kids by Kid Part 3. In Part 2, you learned about what drives the stock price up and down, and you also learned how you can analyze a stock. In this video, we're going to be going over some more core concepts like how to actually place a stock market order and the mechanics of it, and also what risk is and how you can minimize it and mitigate it with tactics like correlation and diversification. Thank you. So our first topic is types of orders. In this lesson, we're say not going to be using I'm not going to be using Google Slides as much to put my information. I'll mostly show you how to do it instead of just writing it here. So our first type of order is market order. Sorry. And here we'll go here. This is the Thinkorswim interface. This is Google right here. Let's try another stock. How about we use CRM? This is Salesforce. And let's say I want to place an order for Salesforce. Hit buy or sell. If we want to buy or sell, hit buy. I want to buy 2 stocks of CRM, so we add the quantity here. This is how a market order is done. Type is here, ticker is here, CRM or Salesforce as the company is known. This is a limit order. I'll go over that a little later, but I want to choose a market order. Market order is the simplest order. It simply just means that you're going to buy a stock or a commodity for its current market price, which is 166.17. So I'm going to buy it for that price. Day order means that you're going to try it that day and it's going to be filled that day if it's a market order, or if it's not filled, it gets canceled. It doesn't do it. I'll talk about what it means to get filled later when we discuss what a limit order is, but pretty much it means that your order is accepted by the NYC or NASDAQ or any other exchange. So here we can only use day orders with market orders because they're the only ones compatible. For example, if we try EXT, it must have day time in force. EXT stands for extended hours trading, which is around like after the stock market closes at like around 4:30, something like that. You still have another extra 4 hours or 3 hours around that time span for you to trade extended hours. Now, at that time, volume will be a little lower, so just keep that in mind. But all I'm trying to say here is that you must have a day order with the market. With the limit, you can do an EXT order. Exchange is best, and then you would confirm and hit send here. And then it would bring up the cost of it. So we'd hit confirm, and then we would hit here. Now, this is an important thing here, which says with market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. In other simpler terms, that means that in a market order, the price that you see right now is not necessarily the price you'll pay because it takes seconds for that for this order to get filled, and in those seconds the price could change. So just keep that in mind. So I'll discard this order because I'm not going to actually buy Salesforce. And next we're going to go over to limit orders. Let's say we want to buy CRM and we want to use a limit order. We simply click here. Now limit order, what it means is that you're buying something at a specified price. When you say that you're going to buy CRM for $166.49, this is auto-generated by their algorithms. This means that you're going to buy CRM when the price is 166.49 or lower. Because after all, you want to purchase stocks that are as low as possible. You don't want to spend too much money. Now, when you sell, it's a flip side. When you sell a stock at 166.49, you want to make the most money as possible. So it says here, so 166.49 means here that the order will be filled once the stock price reaches 166.49 or higher. The limit order, here's the type, and then you can do a limit day order or you can do a GTC. GTC means good till canceled. Day order means it's just going to be tried once. Good till canceled means the order will be tried constantly until it's filled or until you cancel it. EXT means that it's going to be extended hours, and GTC EXT is pretty much the order will be tried constantly during extended hours trading. So, and then exchange best, same here. Then we hit confirm and send. I didn't talk about this, but then you would get all of this information. This would be like result buying power for stock or buying power for options. It's just some you can really ignore this. It's just about how much can you buy, and it's based on leverage, which is pretty much the amount of money, or the multiplier in which a brokerage will allow any client to take out a loan for, depending on how much money they have in the bank. But this is really buying power effect, resulting buyer power for stock, buying power for options. This is usually when you're used when you're running a hedge fund, and the only thing that's useful here is the cost of trade, including commissions. So it costs here 3.92 minus 0.00, which means it's going to cost me this much. Now, the 0.00 is the commission cost. Several brokerages have started cutting down commissions. Commissions are pretty much whenever you send an order, regardless of how big, you have to pay a commission saying that I'll pay you this money. It's how brokerages make money. But recently, some brokerages have decided that we want to liberalize the system of investing. We want to make it easy for everyone and affordable. So we're going to cut down the commission. And TD Ameritrade has cut down the commission, making it $0.00. So that's essentially what a limit order is. Next order is shorting. So I know right now all of what I'm going over can be quite overwhelming, but please do not worry. And what I'll tell you guys is that if you guys start small and you guys start trading on a virtual platform like Paper Money or even Investopedia Simulator or Wall Street Survivor or Market Watch, once you start putting these orders into practice, it's really way easier to understand the mechanics of it than just doing it firsthand at a real brokerage. So we'll use um uh, we'll use ExxonMobil for this one. I do want to expose you guys to a variety of stocks. ExxonMobil, natural gas company, and pretty much what shorting is it's complicated, but I'll try to explain it here. The price right now is $70.33, and I think that ExxonMobil is gonna drop because something went wrong in its corporation. I think that in a week or so, the price is gonna drop to $60. So what I do is I'd make this very risky bet that I call up my broker, or I just use online as it is right now, and I ask the broker, "Hey, can I please borrow a share of ExxonMobil from your corporations or your clients?" And then what the broker does is he or she will give me that stock, and I will sell the stock, and then 1 week later I have to buy it back because I'm obligated to, and I have to buy it back, and hopefully it's at a lower price. Now here's how that works. When you sell a stock, you get some of your money back, right? So when you sell XOM at 70.33, you get $70.33. Now when you buy the stock back, you lose that money. So I have to lose $60 if the price goes down. $70.33 minus $60 equals $10. That's the profit I make on shorting. Now, the reason shorting is very risky, and it's what hedge funds are specialized to do, along with crazy other stuff, is because if the price goes up and there's no limit to how much a price will go up or how much it'll go down, if the price surges up, then what's going to happen is that you're going to lose all that money. When you short, you want the stock price to go down. You're selling before you buy. And theoretically, when you buy a stock, there is a kind of limit to how low a stock can go. It can only go to $0.00. Obviously, but it's still. I'm just trying to convey here that it's still pretty risky because at least there's some limit when you buy a stock, but there's virtually no limit when you short a stock because there's no limit to how high a stock can go. So just keep that in mind about shorting. Now, last one is margin. I won't show how to do a margin, but I will show how to do a shorting one right now. Sorry about that. If you want to short a stock, you can literally just press a button on Investopedia, Wall Street Survivor, and whatnot, or you just hit sell here. Even if you don't have the stock, you just hit sell. Now, back to margin. Sorry about that. I just took that little tangent there. But back to margin. Margin pretty much just means that you take out a loan to sell a stock or buy a stock because you can't afford to buy the stock as a whole. So you would say, I can afford $70.33, or you just don't want to buy it. And then what you do is you would pay for 65 and your broker would cover the rest. You could pay, for example, like $65, broker covers $5, and pretty much whatever gains you get are responsible on that $65. Now, what this really does is it magnifies your profits and your losses, and that's why margin is extremely risky, and I do not recommend it if you cannot afford to buy a stock. If you cannot afford to buy a stock, why would you like take on more risk by exaggerating your gains and losses? Instead, you could buy something like a fractional share, which is a way better practice because you're still getting the same bonuses and it's not as risky as just buying on margin. Buying on margin is usually used again by riskier firms, riskier hedge funds, and it's used whenever you want to exemplify your profits or losses. Now, this is pretty much it about trading orders. We've gone over market, buying for the market price, limit, which means you buy it at a set price that you determine, which is limit is one of the most frequent orders and one of the most useful. You'd only use market orders when you want to get in and out of the market as quick. So day traders tend to use market orders. We talked about shorting, which is selling before you buy, selling at a high price, and then hoping that the stock will go down, and then buying it at that lower price or that discounted price, and then margin, which is taking out a loan to exemplify your gains and losses. Next up, we're going to be talking about what risk is. Now, before I go into the slides, just think about what risk means, and then you can have a clear picture in your own terms and in your own understanding. What is risk? So, as we know it, risk is pretty much the chance that the unfavorable outcome will come. So, that you would say like there's a risk that your ice cream may drop if you hold it with one hand, for example. Or there's a risk that that little figure over there of RISK of those letters may fall. So that's pretty much what risk is. It's the chance that an unfavorable outcome will happen. Now, risk in investing is the chance that your total assets may depreciate in value, or they may go down in value. They won't be worth as much. Now, I'd like to make it clear here that there is no return in the stock market. You can never make profits in stocks or bonds without taking a little bit of risk. Even though bonds are usually comparatively and relatively safe when you compare them to stocks because it's fixed maturity date and fixed yield, the risk that you take when you take a bond or you give principal to someone is that they're going to default or they won't give you your money back. For stocks, the risk is that that asset or that commodity or that like CRM or AAPL or AMZN or XOM would go down in value. That's what risk is. Now, mostly, how do we mitigate risk? We cannot make sure we don't have control on whether or not a stock is going to go down or up, but we can do things to make sure that our portfolio's risk will be as low as possible. So the first method is the most common method of diversification. So here, we'll look here. Let's say we want to diversify our portfolio. We could buy ExxonMobil because it's an energy company. We could have one stock in technology. We could have one stock, for example, we've already had technology, one stock in healthcare, J&J. We can have another stock in healthcare if we want. But what I'm trying to show here is that there's so many stocks to choose from in so many different sectors that you should really do your best to diversify. You can even have an airplane company, BA, this is Boeing. You can have an e-commerce company, Baba, for example, or Alibaba. So there's so many ways you can diversify. Now, when you diversify your assets, here's what happens. If one stock goes up and another stock goes down, they can cancel each other out. And what's going to happen is that the losses of individual stocks will eventually not seem to be as large when you compare it to the portfolio. Now, there is something called over diversification, which pretty much means that huge gains in some stocks cannot be felt because of how many stocks you own. Now, that's not a big problem unless you really overdo it, but diversification is the main reason that A, mutual funds are safer than buying individual stocks because it's a basket of stocks, and B, it's been said many times that monkeys can trade stocks better than professionals. Any monkey can beat the market. Can monkeys pick stocks better than experts? Could a monkey beat your portfolio? Monkeys can actually do that. How animal investors beat the market. Monkeys do not know what stocks are, but if they were given a dart and they could do it without bias, they don't know what it is, and they just threw darts at every single stock, they would create this 100% real diversified portfolio that could easily beat seasoned investors. It's been proved after 100 years of the stock market being opened. Now, another way we can mitigate risk is, for example, DCA, or dollar cost averaging, the next thing up, is if you want to invest $20,000 into MAR or Marriott hotels, but you're not sure if you want to take all of that risk or you're unclear about it, you could invest maybe 5,000 to start. After a month, check how it's doing, and if the 5,000 has grown, you could then invest in another 7,000 or 7,500 or 10,000. The idea of not investing that whole 20,000 all at once is that if the 20,000 goes down drastically in price, or if the commodity of if that commodity that you're investing in goes down drastically in price, then all of that 20,000 will go down. But if you only invested 5,000, you would be able to cut your losses and you wouldn't have as much of a loss. So dollar cost averaging is definitely a good way to enter the market when you're not 100% sure about the trade. Next way is we can use correlations. Correlations is a little more advanced. It's not exactly used by regular investors like you with me. It's more used by day traders on Wall Street, hedge funds, mutual funds, and whatnot. In fact, the name hedging comes from the idea of mitigating risk, or like making risk as small as possible by using various strategies like derivatives, correlations, for example, and others. So it's in this pairs trade window because pair trading is pretty much the idea of using stocks that have correlation to each other to help mitigate risk and whatnot. And you would buy one stock that's going that has a -1 correlation, meaning that when one stock goes up, the other one goes down equally. Or you could buy stocks that have two positive correlation. Pairs trading just means that you use correlations. So here we have SQQ and we have QQQ. QQQ is an Invesco Trust unit. It's like it's CER ETF. It's pretty much like a stock ETF, the whole stock market. SQQ, the S is there because it shorts QQQ. And shorting, as we learned, is that it hopes that QQQ is going to go down. So whenever QQQ goes up, SQQ goes down that same amount usually. That's why the correlation here on this graph is so close to -1. -1 correlation just means, as I stated before, if one stock goes up, another stock goes up the same amount. +1 correlation means that if one stock goes up, another stock goes up that same amount. Now, the reason they subtract SQQ or QQQ from SQQ is pretty much they want to see the range. They want to see, is there a huge fluctuation and how much. As we can see here, there's not a huge fluctuation, and that's why it has a -1 correlation. -192 is very close to a -193. So here you can see the correlation is almost identical, and like it's almost in the same range, and therefore it has a -1 correlation for most of the time. Excuse me. Now, if you want to see stocks at a positive correlation, we can use SPY or SPX. SPY minus SPX. Here we can see the correlation is still pretty strong. This is a +1 correlation. They're both S&P 500 indexes or indices, and yeah, here we can see 2904 is pretty close to 29112 comparatively to like the number itself. So we can see that they have a positive correlation of like 1. So this is just another fancy method I wanted to show you guys. Hey guys, thank you for watching that video. Hope you enjoyed it and hope you learned something new. Please hit that like button below, and if you have any feedback, please put in the comment section below as well. Also, share this video as usual to any friends and family who might be curious about investing and growing their financial futures. Thank you for watching.